I want to take a little trip to the past and talk about the Fed's secret $47.93 trillion bailout. That's right, you heard that correctly. This is going back before the COVID dip, before any of the trillions of dollars in stimulus were printed and handed out, and this is an event that happened before that. And as we've seen throughout time is usually before the big crisis that we all hear about, there was these series of events that led to the eventual recession. Same thing here. Now, before we get started, most of this research was compiled from two places. I want to give a shout out to Pam and Russ Martins of Wall Street on Parade and the Occupy the Fed Substack. Both of those are great resources. Check them out. The links will be in the description. Okay, let's dive in. Rolling back time here to September of 2019, we had a Fed repo market crisis that had occurred, and most people don't even know about it. Now, it started and the triggered event was on September 16th. There was a trader, Thomas Cook. He's a UK-based trader, by the way, found himself on the wrong side of what? A credit derivatives trade that wiped out about $2.7 billion off the cards. Now, if this sounds familiar because of recent events with Archelaus, then you'd be correct. That's the same thing that's happened. The same thing that we've seen happen throughout time is that essentially one firm or one trader gets on the wrong end of credit derivatives, swaps, trades, and riskier assets, and it goes against them, and billions of dollars are wiped out. So on September 16th, 2019, Thomas Cook filed for Chapter 15 bankruptcy and protection in the US District Court of New York. One day later, the Fed starts its repo operations. Now, between Q4 of 2019 and Q1 of 2020, the Fed lent out essentially $47.93 trillion in repo bailouts. And like I said, the public doesn't even know it. So there was two tranches that were essentially given out. The first one in Q4 of 2019 went to primarily 6 global banks, had received 12.26 trillion of the 19.87 trillion, or 62% of the total, out of the 25 plus trading floors. Those 6 global institutions, notice I'm saying global institutions, were number 1, Nomura Securities International, number 2, JPMorgan and Securities, number 3, Goldman Sachs, number 4, Barclays Capital, number 5, Citigroup Global Markets, and number 6, Deutsche Bank Securities. Notice how half of those are affiliates of foreign banks. Nomura is in Japan, Barclays, the UK, and Deutsche Bank is German. Now, in Q1 of 2020, again, 6 banks received a total of this time 17.66 trillion out of the total of 28.06 trillion, adjusted of course, or a total of 63% of the total that was supposed to be given out across 25 plus trading floors. At the top, number 1, BNP Paribas at 3.84 trillion. Number 2, JPMorgan at 3.6 trillion. Next, Goldman Sachs 2.8, Nomura 2.7, Citigroup 2.6, and lastly, Barclays at 2 trillion. Okay, now at this point, I'm sure you're probably thinking, what is the repo market? What is a repo operation? What is all this? Simply put, the repo market is essentially a tool that the Fed uses to extend liquidity to banks at usually a very small time frame to help them with operations. So the Fed operates essentially a 1-day overnight loan market, but it periodically also offers a 14-day, 28-day, 42-day amongst other term loans as well. So understand that these numbers that we just shared, we had to adjust the cumulative tallies to account for the term loans in order to get the accurate picture as to who got the bulk of the loans from the Fed. For example, let's say a trading firm took a $10 billion loan for a 1-day, but on that same day took another $10 billion term loan of 14 days. The 14-day loan for $10 billion represented the equivalent of 14 days of borrowing $10 billion, or a cumulative tally of $140 billion. If we simply tallied the column the New York Fed provided for trade amount per trading firm, it listed only $10 billion for that 14-day term and not the $140 billion it actually translated into. The trade amount column for the first quarter of 2020 comes to $4.4 trillion, while the term adjusted total comes to $28.06 trillion. Now just imagine for a second if this became public, if this was audited right after and the Fed had to come out and admit that this was not only the second bailout for most major banks in the last 11 years, but it also once again took care of foreign banks. Imagine the embarrassment that would create by them having to come out and admit this. Also too, it's important to note that this is once again derivatives trades got out of their hand and out of control that caused this problem. This seems to be a reoccurring theme that we see happen over and over and over again, where one bank literally has a ripple effect that is seen globally and affects global financial markets, which speaks to the sensitivity and the fragileness of the entire financial system globally, doesn't it? Okay, so let's talk about some of the fallout and some more interesting corollaries here that occurred. So we had the BIS, the Bank of International Settlements, basically the central banker's central bank, had come out with a report called the September Stress in Dollar Repo Markets Passing or Structural. This report highlighted and found some seemingly obvious truths. Things like this was not a one-time passing event on the repo market, but is a structural problem in the liquidity plumbing itself. It also highlighted how just 4 commercial banks are now the dominant lenders in the US repo market. The BIS also found that hedge funds exacerbated the turmoil in the repo market with their desire for borrowing money to spice up returns on their trades, aka looking good to their investors. So the exact words from the BIS, US repo markets currently rely heavily on 4 banks as marginal lenders. As the composition of their liquid assets became more skewed towards US treasuries, their ability to supply funding at short notice in repo markets was diminished. At the same time, increased demand for funding from leveraged financial institutions, i.e. hedge funds, via treasury repos appears to have compounded the strains of the temporary factors. Now, one other interesting thing to note is the New York Fed was in charge of handing out this money during the repo crisis, as it was in charge of handing out the money during the great financial crisis of 2008-2009. Now, what's interesting about this is the largest shareholders happen to be 5 of the largest banks on Wall Street, and several of them were at the receiving end of the largest amounts of the emergency repo operations. JPMorgan Chase, Citigroup, Goldman Sachs, Morgan Stanley, and Bank of New York Mellon or Milan. These 5 banks also represent 2/3 of the 8 global systemically important banks according to the Financial Stability Board, which was formed just after the great financial crisis in 2009. Next, what I want to do is I want to give a breakdown of some of these banks and where they currently were at the time and just before these bailouts occurred, because I think that's important context. Some of these banks were in very rough shape. Where I want to start is I want to go straight to Deutsche. Deutsche Bank was in very bad shape at the time. It seems like this bank just cannot catch a break. It's scandal after scandal after scandal, and it is not being run very effectively. This usually, from a consumer standpoint, would not be a good candidate to borrow money, right? If you went into a bank with bad credit score, with low ability to pay back, a lot of derogatories on your record, right? You're showing that you had internal problems with running yourself, your life, your business. Would that be a prime candidate to then walk out of the bank with, essentially a blank check? No, it wouldn't. So Deutsche Bank is a major derivatives player in the Wall Street mega bank scene. It was having serious problems throughout 2019. It attempted to merge with Commerce Bank. That fell through in April of 2019. It announced a plan to fire 18,000 workers by July of 2019 and had plans to create a good bank, bad bank, isolating off toxic debt that it had planned to sell as well. It incurred losses in 3 of the prior 4 years. Its share price had lost 90% of its value over the prior dozen years, and it was trading close to historic lows in September of 2019. So again, is this a prime candidate to get funding? No. The Monday after the emergency repo loan operations began, Deutsche Bank announced that it would be moving clients and staff from its prime broker unit that makes loans to hedge funds, etc., to BNP Paribas, along with its electronic trading operations. On September 17th, 2019, the first day of the emergency repo loan operations, Deutsche Bank borrowed $1.5 billion in a 1-day loan. By September 24th, Deutsche Bank had upped its 1-day repo loans to $7 billion. By September 25th, Deutsche Bank once again increased 1-day borrowing to $9 billion. And by the 27th of September, it had took another $3 billion in a 14-day term loan and rolled over $6 billion in a 3-day loan. On October 8th, 2019, just 13 days after Deutsche Bank's headquarters in Frankfurt, Germany were raided by the police for the second time in less than a year. The police were probing a vast money laundering operation that was running throughout Europe. But even if we go back a little bit further in time, we see on January 30th, 2017, Deutsche Bank was fined a total of $630 million by the US and UK regulators over claims it had laundered upwards of $10 billion on behalf of Russian investors. And lastly, if we go back in time just a little bit further again, in June 2016, the International Monetary Fund, or IMF, released a report that found that Deutsche Bank posed the greatest threat to global financial stability than any other bank because of its interconnections to Wall Street mega banks and large banks throughout Europe. It's kind of interesting how just literally 3 years later and a ton of disaster and shame later, this turns out to be true, and they are once again finding themselves at the good end of getting bailed out. Next, I want to cover Nomura, which is a bank based out of Japan. This is also top 6 receiver of both tranches of bailout throughout 2019 and 2020, as we previously mentioned. So on the screen right now, what you're seeing is the financial statements from Nomura Security International themselves. They had a total asset amount of 127.5 billion, but the potential derivatives exposure was much greater. A maximum payout on protection sold on credit derivatives of 14 billion and a maximum payout on derivative contracts to meet the definition of a guarantee of 97.7 billion. But here's the scary part. In this pile of derivatives, the name Nomura does not appear once in the report on derivatives that might pose a potential threat to the US financial system that's published quarterly by the Office Controller of the Currency, OCC. It hadn't appeared through 2019 and still hasn't appeared to this day. So Nomura is a bank that not only got a bailout, but is not even being calculated in the global financial system until this very day. Okay, next let's cover BNP Paribas. So this is a bank that probably you didn't even know about, you didn't even know existed. But apparently it has deep inroads with Deutsche Bank, is able to get billions of dollars out of Wall Street, trillions of dollars out of Wall Street in bailouts, and the taxpayers are essentially footing the bill in 2 different ways. Footing the bill in inflation, footing the bill in taxpayers paying this back. All right, so BNP Paribas Securities, which is part of a French investment bank, first off, on the first day of the repo crisis, took 5 billion of the 53.15 billion, or 9% that was being offered. They went on to take much more, but this is the same bank that the US Department of Justice fined 8.8 billion in 2015 for flouting US sanctions, covering their tracks, and pleading guilty to criminal charges. Now, what might have led to the scramble for money by BNP Paribas Securities is, wait for it, risky derivatives trades once again. The same financial weapons of mass destruction that blew up the US financial system through the great financial crisis in 2006 to 2008, once again peeks its nasty head and is a main contributor to the Fed Repo Crisis in 2019. Lastly, let's talk JPMorgan. On the first day of emergency loan operations, September 17th, the New York Fed provided a total of 53.15 billion. As previously mentioned, JPMorgan Securities was the largest borrower at 7.6 billion, or 14% of the total. Now, it's important to note that JPMorgan Chase, the parent company, owns the largest depository bank in the United States. At that point in time, JPMorgan Chase held $1.6 trillion in deposits. So why would they need to borrow 7.6 billion from the New York Fed on the very first day of this emergency operation? Now, it's important to note that before the repo crisis occurred, in the first 6 months of 2019, again, long before this occurred, Reuters was even reporting that JPMorgan Chase had reduced its reserves it was holding at the Fed by $158 billion, or an alarming 57%. To this day, nobody knows why that occurred, but early on, people were actually blaming JPMorgan Chase for causing the Fed repo crisis to begin with. Now, we've gone through a lot of data. There's a lot more in terms of what these players were taking out each and every single day, but the big thing to focus on is the totals. Now, understand, to get to this point, for the longest time we had no data. Then we thought it was a total of $9 trillion. And now the Fed, after 2 years, has finally been forced to actually name these banks and give out all of this information, which you're seeing in front of you right now, the transactional dump on the New York Fed's website itself. I think the big takeaways here are, first off, that this information should have never been kept from the public. Secondly, is clearly credit derivatives products are very, very risky. And thirdly, is that there needs to be a big, hard look taken at the big institutions and just how much leverage that they're able to take out, because if one bank can potentially collapse the entire financial system, which again, even since 2019, we've seen happen 2-3 additional times through the US with different firms, with Evergrande in China, all of these situations have a big ripple effect on global markets. This needs to be looked at. There needs to be a more serious look taken, an approach taken to these banks, what they're able to borrow and leverage up against. And then of course, these reports and institutions about what banks are really the big players that need to be paying attention to. Rules need to change. Oversight, or whatever you want to call it, needs to occur. I'd love to hear your thoughts. This is the first, peeling back of the onion of this data. We'll probably do some additional videos covering more in depth about the daily numbers and some of the deeper stories that occurred here. But this is by far the biggest news story that the media has not even covered. Outside of alternative media, you really probably haven't even heard of this, have you? But yet it represents a major turning point of inflation and how much circulating supply of US dollars occurred. I'd love to hear your thoughts in the comments below. Subscribe if you haven't already. We've got more videos like this, personal finance, etc. coming very soon. Hit the bell notification, turn it to all. Be on the lookout. More deep dives coming soon. Thank you so much.